Introducing the 3-part options course with Hans Albrecht. Get access for free by scanning this QR code or clicking on the link in the description.
All right, let's get this show on the road. Welcome everyone. It is Macro to Micro Options Power Hour. I am Samantha LaDuc, founder of LaDucTrading.com in snowy New England, and joined on the other side of the continent out there in Toronto, also I'm sure equally chilly, is Hans Albrecht, our options mentor, educator, you name it. He does it as it relates to options. And we're coming together on this Wednesday afternoon after the close to talk market, a little bit of sector rotation, as well as, of course, stock selection, and especially how macro right now is kind of driving some of this bullish bent. But I want to know, when does it end? What are your option signals, smoke signals, whatever you got going for you there, Hans? Show, are we about ready to exhaust this buying euphoria? Not just the gap down into the Monday, January 13th gap fill from the November 5th election, but we didn't just run into inauguration, we just keep going. So we're kind of melting up here. What are the probabilities for continued strength? And I will also give a caveat that you know how I am about this. It's bullish until we have a macro flow to interrupt, a macro trigger to interrupt the bullish flows. And right now we do have jobless claims coming in tomorrow, which even though it's under the same BLS director, apparently, we definitely have potential for price discovery, which we really didn't have for the past few years as it related to continuing claims, jobless claims, unemployment rate, all that good jive. And then, of course, we have Bank of Japan, which is high on my list of important macro triggers, because if they do hike, there can be some interruption to yen shorts that cover, which further puts a little bid in bonds. And at some point, bonds will get a little bit too strong. Yen will get a little bit too strong. Not right now. Right now, they're affecting a softness in yields and dollar, which has helped equities get bid. But then they leave the Goldilocks zone, or as you say, the porridge, is no longer, warm. And then they start to put some heat into the market and we start to unwind concentration risk. So with that said, we've got some short-term, risk dead ahead for tomorrow morning and Friday. But after that, what are your option flow indicators and everything else look like for this continuation of this advance?
Well, Samantha, good afternoon. Yeah, it's kind of an interesting market, right? It's almost, we talked about it last week, how we'd almost get a second chance at the Trump bump. And we did. We got a second kick at that can. Markets kind of got a little bit nervous. We saw both mag stocks sell off. We saw broader stocks sell off. And as we touched that 5,800 level, we started to talk about how, things are looking a little bit scary from a gamma perspective. We could get into an area where, we get that snowball effect of selling begets selling, and effectively you get this thing that I always talk about, which is vol clustering. Either we're kind of not much going on or things start to unravel a little bit more quickly. I mentioned that if we can get back above 6,000, we're going to get into this sort of the warm embrace of, that positive gamma effect again, as we move away from some of these strikes that are a little more concerning from that gamma perspective. So I think we've done that. Of course, we're back up to, 60.80, 60.86. We blew right through that collar strike at 60.55, but of course the collar's not there anymore. It's quite a bit higher, but I think we're in that silo of kind of 60.25 to 6100, where I think we should probably top out here a little bit. What we started to see today was kind of interesting. And I talked about it early in the morning. I said, watch the VIX today. I told members, I said, watch that VIX, because it's probably not going to drop very much. It was down maybe 30 cents or so, or 30.3 or so. And I said, it's probably not going to keep dropping because the market is starting to move so strongly to the upside that even it's going to get nervous. And we saw that a lot with those parabola stocks we were watching for, after the Trump election, after the election. So
did you notice that VVIX was also green first thing this morning and stayed green?
It stayed green, right? So it's a little bit too much for vol markets to handle. It's a little bit too much upward movement, and people don't typically think of moves to the upside as being associated with firmer VIX, but it is. It's not as pronounced, right? It's not like when the market sells off and you get those big spikes in the VIX. You're not going to see much like that to the upside because markets don't crash upwards very often. But this is a little bit of spot up, vol up, spot up, VIX up, and so to me, it's kind of a little bit of a sign of a bit of exuberance and maybe, just a little bit too much excitement. And you're seeing it play out in some areas. I bought some Nvidia calls yesterday and I said, this option price is a little bit cheap. We could actually see volatility rise if it keeps going. And we did see that. It was a very, very small amount, but Nvidia had a good day and you actually saw option pricing firm up on it. So we're starting to see just a little bit of that effect of calls getting bid up. And that's a little bit of excitement to the upside that has the potential to continue a little bit, but I think that's running out a little bit. So we have a question in the chat, which is, do you think S&P 6150 are going to be the highs, or 50 or 548 on the Qs? Didn't you mention something around that level, 61 something?
Yeah, so let me just show, this was a client post back on January 3rd, but I have to put caveats around this, right? So there's chase, swing, and trend time frame. Bigger picture in Q1 at some point, I've been talking about this 6150, and the rate, the ones that he's talking about in particular are right here, right? So SPX,
Gotcha.
6150, QQQ, 548, SMH, 272, and Nvidia, 260 to 270. I actually have 271, but the point is it's up there and we might need earnings to get us there. Okay, so that was
160 to 170, right? Right, Samantha? 160 to 170?
260 for Nvidia.
Aren't we? Hold on a sec.
I meant one. Oh my God, you're right. Okay, so sorry, I got the two in the front. Yes, no, not double. Okay, so forgive me. Okay, 136 is where we've been gyrating. 152.53 is the previous 52-week high. I'm only talking really 170. Great catch. Anyway, the point is I'm bullish for Q1 for these levels to hit. And then most likely we reverse lower in Q2. Earnings won't be that great. And then the second half of the year, I'm a little bit nervous about this. But yes, I do have this kind of one more Mag 7 high in Q1, but trying to time it is very difficult. And by the way, that's the JP Morgan collar that we now have that expires March 31st, which is the 6165, which is always typically a magnet. So it's kind of pulling out. That's a call that I have for Q1. 545.48 with Qs and 6150 and 272 for SMH and 170 for Nvidia. Okay, so, but the timing of that is harder because we have a lot of interruption, if you will, with the macro backdrop. FOMC is coming in very soon. Will they pause? Are we having, and I can undo that just a second. Are we going to have a Bank of Japan hike? Are we going to have tariffs? So the first few days of the Trump administration has been, well, first we got through the inauguration, so no volatility there. And that oversold bounce has been very strong. We were extremely oversold. So we have an oversold bounce of strength, and it is stronger than I expected. I really didn't think we would get above today like we did. I thought we'd have 60.53, and I can show you that as well, which I show clients all the time. And then we would start to roll back over Thursday, Friday as we got in closer to the Bank of Japan. We haven't rolled over yet. And so that's why I'm asking you, this is obviously a market that has repaired underneath the surface in breadth, also in volume. The option flow has stayed very bullish. But now, is it getting a little bit melt up feel to you? Or do you think we actually will start to hit some turbulence, get a softening? Because right now, the main reasons have been softening dollar and yields. And they have been right on cue coming back down. So that 10-year hit 4.79, which was absolutely target, and then it softened. It still looks like 4.49 can come in. And the dollar, of course, went all the way up to, nearly 110 and is already down to 108. That and energy also has softened. So you've got the trifecta, if you will, of tailwinds for equities, plus the sentiment. But what do you see in the option flow? Bullish or bearish for the next few weeks? What's your call?
Well, I think the sort of inflation narrative kind of caught on for a little bit. And we saw commodities have a really, really good run, including oil. We've seen gold do well. Silver really lagging a little bit. I'd love to know your views on that a little bit later. But silver really kind of lagging. I own a little bit of that. I'm trying to figure out what to do with it because it is really the kind of poor sister right now to gold. But yeah, look, I think the administration is positive. So I'm not getting super bearish. I can't predict another sort of yen carry trade. I guess we can almost predict it because they could hike, but I'm not sure it's going to have a similar kind of effect, but I will say that we are seeing some, last time we talked about how these vol targeting funds, these funds that need to de-lever when markets come off and volatility rises, they got down from an 80 something percentile down to a 40th percentile allocation. So we definitely had, I kind of gave you a good story, bad story, and there were some things that supported a potential rally in there. I think those things are still in place. I think if we get volatility down, which could very well happen, because if we are indeed past that kind of vol trigger point into an area of more stability, as long as we stay in here, I know that's a big if, as long as we stay in here, it should be good. And we're going to see a lot of vol supply. So what that means is we get up in here and VIX 15, 16, people start hammering out calls, dealers take on a lot of that flow. And then that kind of continues to bolster the argument for more support of the market because it becomes gamma rich. So I think there's definitely, it's a bit, I think the glass is half full, because I think there's a lot of optimism out there that things are going to go okay. I think Trump is really sort of a bark is louder than the bite kind of situation. And you sort of see that in some of the things already where, it was all about extremes because that's the art of the deal. And then you dial it back and then you try to make a deal, and the market likes deals. They want to see a good deal where overall the porridge is warm. And so, they say a great deal is where both sides are not really satisfied. So I don't know. I think Trump wants to kind of lean, to being a little bit more satisfied with things. So I think it's pretty good. I think we're in an age of incredible innovation again. I think there's a lot of pluses to what's going on out there. So a lot of money being spent on infrastructure. So I'm generally positive, but outside of those things, maybe we do get some structural issues. So for now, I feel like it could be a bit of a buy the dip. But having said that, if we do, I'm looking at some of these dealer positioning charts. Let me send the request over you to get in here.
Done.
We can see some of these areas. So for example, VIX, where it's sort of been your and my favorite place to kind of hide a little bit from a hedging perspective in the last 6 months, ever since August 5th, we've really seen that sort of cat in the room full of rocking chairs, very, very nervous, very easily made nervous. And we can see that upside is very lopsided from a dealer perspective in terms of they're not really positioned well to the upside, which means if we get the VIX going, they're going to kind of panic. A lot of Vega per 10-point move in volatility. So VIX total Vega. So there's a lot of potential kind of kindling there that can catch fire. And we can see here VIX call skew very, very high again, 94th percentile. So these things are, I think it's interesting because when we get below 100 on the VVEX and around 15 on the VIX, I think VIX as a hedge starts to get interesting again. And so I think that sort of emboldens people to stay long, but have some reasonable protection that can keep them in the market and keep betting that things are going to go up. I don't know. I like you said, we need that trigger point to get us to break below. Whereas I think over the last few weeks up until recently, you didn't need that trigger. We were in the midst of volatility and it was going to continue no matter what. Now we're kind of in that warm cradle of support up here above 6,000. I think that can continue for now. Let's see here.
I love how you put that, the cradle of warm support. It sounds so inviting. You don't get any sense this is a bull trap?
I don't. I think for now we're in pretty good shape. I think we're in pretty good shape for now. Now, can that change? I think we're sort of, a few people have been flipped around upside down a little bit last little while. Some very smart vol people, smart market people, and they've been calling for volatility in January, but then trouble after that. And we sort of got the volatility in December, a little bit in January. And I mean, there's no telling what can happen, but we need that trigger, right? I think that yield bumping up a little bit today. You saw the IWM kind of pull back. The Russell sort of had a little pause into just a little touch of higher rates. So that's something that could get people nervous again. Definitely.
Let's talk about that a little bit. So I want to show a chart that happens to be the SPX on a 2-hour, okay? And over here on the left, I've shown this before. This is a dollar yield, 10-year yield ratio that I use. And if you recall, because I do this every single morning in the trading room, once it gets over a key level, which is about 300, it becomes very dangerous to equities. And that's when we started to have some chopping and then some indigestion, like the 3% down day in SPX on December 18th. Just recently, right, we had this kind of head and shoulders formation over here. This is also on a 2-hour, but just kind of show you. And this was the one thing that would cause the market to move higher into the election gap low of January 13th. And sure enough, this dumped below a trend line. Anyway, the point is, and we opened up right here. This was a really powerful burst. This is the election low right here. The January 5th gap up. We filled January 13th. And then I said, if this rolls over, we get a weakness or a softening in the dollar and yields together, obviously, then this ratio will dump and we will start to move higher. We didn't just gap. I mean, we really gapped and we gapped again. And we gapped a little bit here. We gapped again. We have just been straight up hockey stick as it relates to all of these gaps that are being left below. Hence the reason why I'm saying, I know you like this positive gamma, warm embrace, etc., and definitely yields and dollar falling is very supportive for equities. It's still, however, over my 300 mark. So it doesn't say it's safe, but we just need a macro trigger to have this come right back down. And again, we don't know now that we've got kind of new administration, what are we going to get for price discovery in and around the labor market? And then, of course, what are we going to get for Bank of Japan and the Fed? If they pause, it's bullish. If they don't, we'll see. But the point is, we've got some animal spirits that are still very, very caught in this long-only market. You can see what happened with the announcement also today of the 500, billion potential, and it's potential, not reality, and how the market reacted with semis. So semis are clearly still driving this bullish narrative, and I love it. I mean, this finance call spread in Nvidia, this bullish bent for 272 for semis, this bullish bent for the Qs and etc. But I don't trust it. So that's where I don't feel it's a warm embrace. I actually feel this is a sucker's rally. I feel really strongly about that, but I've got no signals whatsoever that we're going to turn around. So for right now, it's more of a be careful what you wish for kind of thing. I think I
got to hand it to you. You have been very steadfast in with your SMH target. Yeah, I'd say that's the interesting thing is that, as soon as you get the bears a little excited, they have a big meeting like Trump had yesterday and further evidence of, CapEx spending. We've seen the power generation kind of theme really, really take off, which I was writing about earlier in the year, is one of my favorites this year. So things like PWR and my uranium plays, which really started to take off today, CCJ. I can show everyone a little trade that I did. So CCJ, Next Gen, which is my takeover play in the uranium space. Canadian plays, right? We want homegrown stuff. I mean, as far as Canada's homegrown, but it's nearby. So I think some of those things just keep this CapEx, this energy, this sort of infrastructure. It kind of keeps the ball going. Again, you're right. It gets in the way of perhaps maybe some natural weakness that should be coming about. But like you said, maybe it is. That's a lot of gaps. You showed a lot of gaps on that chart. There's no question about it. That's very gappy.
And you know how I am with that. I'm very patient. I know that when I start to see the indigestion, the topping, then it's much easier to identify the short targets. I haven't seen the rollover. So remember with McDonald's, I'm like, it will. It's not a question of if, just when it will come back and fill that gap at 279.50. It took a few weeks and then it rolled over. I mean, the point is, these are gaps that will get filled. It's just a question of when, not if. And right now, this has been a stronger bounce. Obviously, we just blew right through above the 60.53. We opened up, right, 60.82 or whatever, and just kept going and made new highs. So we're in blue skies. And semis are leading the parade, and with good reason. I have been bullish that space. But this is outsized. Like when you kind of take a look and you say, all right, so we got that announcement was, for those who are not aware, Trump is standing by the CEO of SoftBank and OpenAI, Sam, the Sam from OpenAI, and of course, Oracle, Ellison's Oracle. Oh my goodness, what a field day. today, Nvidia, semis, and also ARM. ARM is also an investor. I mean, this is gorgeous. I don't want to even try or attempt to short this thing. I've got it on a weekly time frame, and I've got clients who are long this as a theme, right? So they're not just chasing, they're not looking at a 1 hour chart and going, ooh, that's great, let's go. They're looking at this as a big picture, and they're willing to kind of trade with options around some of this stagnation for 6 months, for example. This is extremely bullish. This breakout on a Bollinger Band on a weekly above monthly is very bullish. The market looks melt up like this isn't a bounce. This is, oh, and I love that expression that I posted in Trading Room Notes as well, which was, I read, if you want to see sharks, put some blood in the water, right? And it was referring to Trump basically announcing this AI initiative named Stargate with Ellison and SoftBank and Sam Altman, of 500 billion, which really is not realistic. In fact, Musk chimed in to debunk it. Gavin Baker, who's an excellent AI analyst, highly recommend following his feed on Twitter. And he's like, there is reality and then there's fiction. Stargate is fiction wrapped around a much less impressive reality. And he is incredibly savvy and gung-ho AI. He is not a doubting Thomas at all. So the point is, be careful. I just see a lot of this as kind of approaching some buying exhaustion, unless we're going to go full on melt up like that ARM chart seems to intonate. Otherwise, all I can do is basically say, like you just said, stay long, but then I have to say, okay, but if we happen to break down on these levels, that's your signal to reversion to the mean is coming in. Take care. And like you said, there are tons of trends that are still doing amazing work, whether it's in the brokerage trading arena or whether it's in the power data center arena or the medical device with a little hint of AI arena. I mean, it's ridiculous how bullish the market is in the sectors that matter most to that sentiment of AI with a side of quantum. But it's getting me nervous now because it's not behaving rationally. And I'm now starting to think, all right, what if we do get a melt up sooner rather than later? Because a melt up will then, it's a foregone conclusion, will also very likely have the melt down pulled forward a little bit. So for right now, I wanted to just gently tag those higher levels, not have such a big breakout right here, right now, 3 days into the Trump presidency, especially if we do not get, by the way, a Bank of Japan hike. That's going to be bullish for the equities. We're also that rate differential that I show all the time for clients, that rate spread is still bullish. So between US and Japan, if we don't have the Fed, well, they're not going to hike, and they're likely not going to cut either. They're likely going to pause. That's also very helpful. So if we kind of follow through with more liquidity from Basent, that QRA, that whole quarterly refunding announcement comes in February 2nd, after FOMC on the 29th, after Bank of Japan this Friday, if these characters all line up to support the equity market, and Trump wants that, right? He's watching the market at all times. He knows how to goose the market at all times. Again, if you want to attract sharks, you put some blood in the water.
Yeah, for sure. There's definitely a narrative that he wants to follow. He's absolutely pro-market. I think this is definitely part of it was an unraveling of what started at FOMC and sort of this idea that maybe we could even be facing some sort of potential for a rate hike, which we quickly kiboshed with those inflation numbers, reasonable employment numbers. So really it was a couple of very warm porridge reports came out, and that kind of put the nail in the coffin for the bears for now, right? I mean, any of these things that you're talking about are definitely valid.
I'm still in the camp that they're gonna pause now and cut later. But I've been saying this. This is not anything new. So I really expected this Fed pause for January, but I think we're going to have more rate cuts than are priced in. But that's later, not in Q1. Anyway.
But that could be a really good thing. Silly me, I got out of my IWM around 224. I thought, oh, you know what, a bit of higher for longer, and then combined with the reasonable inflation pricing pressure numbers, and then of course Trump and his whole positive circus that he brings to regulatory issues and things like that. So that's kind of looking good again, but again with a little bit of a pause in rates there, a little bump up slightly higher higher. IWM paused a little bit today. But look, I think there's interesting things. I mean, Netflix put out fantastic numbers. One of my favorite stocks. We've got one of my cash machine trades on that. So one of those in the money call sales against the stock into earnings. Now, I don't mind. I don't typically like to play earnings just because I don't think there's a lot of edge in it. And Netflix really another example of why there is an edge in earnings. They were expecting about a $70 move, and I think we were up $130 on the open or $125 or something like that. So, they often underprice these moves, especially to the upside. There's still definitely some good stories out there.
I like how you said that. There are stories out there. I actually thought that report was very mixed. In fact, I would really expect this to kind of overshoot the 1,000. It already tagged that after, but a little bit more, like 1,035, and then roll over. Like, I don't think it's going to be able to sustain this elevation. I think at best it'll go sideways, and more likely, I didn't think it was as bulled up, but the market is bulled up, right? The calls are still cheap, and like you said, they also lowered the bar for this earnings season. They have to really, really delight. They didn't. They still got bid up. So I think the market just wants to run higher. The
leaders just command the attention, and we've seen that for a long time now. The leaders command the attention. If you are far and away, a Netflix everyone's playing for second place, and they have such pricing power. I mean, my family would kill me if I canceled Netflix. They could probably raise monthlies $25, $30, and a lot of people wouldn't be able to get rid of it. I mean, it's like having running water in your house for most people. So, I'm not saying that's the case for everybody. I have to be respectful of a large segment of the population struggling with inflation, and of course, every dollar counts. But Netflix is they're just hitting on all cylinders here, and so it's you've got those great stories, but it's up 400% in a couple of years. I mean, it's had a good run, but it still trades. You look at next year's expectations, it's trading at 26, 27 times. It's still reasonable, and so that's the problem. We get these extremes in this market where they will give the leader unlimited from a valuation perspective. Multiple expansion can really go. When you're one of those stocks. So we down around 860. What I did was Netflix around 860. I sold the Feb 800 call for about $82. So what we're concerned with is time value here. So I'm trying to target about, roughly about 2% that I want to grab in about a month of time value. So it's a strategy where we talked about one of these a few shows ago, where this is a way to grab a little bit of intrinsic value, a good amount of intrinsic value, and then a little bit of that extrinsic value, which is time value. So at 860, the way you figure it out is if you take 82 away from 860, you end up with 778, and that's about $22 under the strike. So you've got $22 of time value in something like this. Nothing happens, or the stock just effectively runs up like it did, you're going to grab that $22 if you just kind of stick around. And that's the idea, is that you're just trying to grab those little yield wherever you can, but also have a downside hedge, because a criticism of covered calls is often that you don't really get much of a hedge. So this is really, effectively what you're doing here is you're selling a synthetic put, basically. But it's a way where if you own a stock, the problem with certain option strategies is that you have these events, instruments with limited lifespan. So you kind of constantly have these taxable events. So this is a way to sort of maintain that underlying core holding and sort of work your way around it. So we bounced today, and the time value went from about $22 down to about $3.50. So I bought back that call and rolled it into a March 950. So I got $65 for the 950. And what that does is it gave me about $35 in time value. So that's a bit more bullish. That's more than that 2% that I typically look for. But I was bullish. I wasn't expecting it to pull almost all the way back to 950 today. So it's starting to threaten my strike a little bit, although I have room to be wrong all the way down to about 915. But that's basically the play, is that you're just trying to grab. So in this case, it's about 3.8% risk on the underlying, but it requires Netflix to stay above 950. And my view is that you're going to probably start seeing more upgrades come in. The lemmings are going to jump on board one by one. They're going to come in and go, wait a minute, we need to upgrade our expectations. And I think you sort of get a little bit of that positive support there from the street. But again, it pulled back to 950. So I wasn't quite expecting that. But again, I'm not worried about it. Worst case scenario, I own Netflix down in the low 900s, though that's quite a bit higher than where I recommended it on TD Ameritrade at $225. So I'm not going to be happy if it gets back down to 225. That's for sure.
So I'm not interested in the Mag 7 plays except for Nvidia. And once Apple comes down to the 200-day, about 217, I think it's going to get defended, and it probably bounces, into its earnings, runs, I should say, post earnings, because it's just extremely ripe for some relief. Just like we had a relief bounce of size, a Vanna rally, for lack of a better word, since the election gap last Monday. I think Apple should also do well. I'm looking for the stuff that's oversold value. So let me show you a stock of mine before you go into the historical on this. So one that is boring but profitable is 3M, long forgotten. There are a few stocks like this I'll kind of show you. And one of the things that I like to do, believe it or not, is to take a look on a monthly chart when a stock is extremely oversold and it has, some fundamental weakness to it. Plus, of course, the FANG stocks are just grabbing all the attention, the power producers, the AI, the quantum, the this, the that, and it's left really for dead. One of the things that I liked about this last year was that it formed on a monthly, a very tight inverse head and shoulder at the 400 month, which is basically my do or die level. When a stock falls below the 400 week, in essence, it suffers terribly. If it can bounce on that level, it's very strong. So anyway, long story short, it did start to produce a fabulous trend reversal pattern. And then again, remember, this is on a monthly over here, okay? It did a fabulous job of getting up when the concentration risk was unwinding. Remember the June to July? And then August 5th, everything changed when we hit that big convexity rally. Well, while the concentration plays, in other words, semis, were coming down 25%, NASDAQ, this is into the August 5th low, right, during July. While we were having that pullback in FANG, basically, in the Qs, 15%, semis 25%, Nvidia 35%, 3M was rising up. So that's when value starts to come in, and I look for those plays. So anyway, long story short, if I look at this on a monthly, okay, it was just doing fabulous. It was consolidating beautifully on this monthly level. So one thing that I suggested for those who really did like this or already were holding it was selling the 120 puts and buying the 140 by 150 call spread. So you know me, I love that finance call spread because it looked so good. And it went right up through this 141 monthly again into a 152 weekly resistance and started to digest a little bit. But this thing is still in play. And I really am excited when I can find a play like this because you can keep rolling. It takes time. Now that it's gotten up here, it's going to take some time. But the point is, once it gets above these trend lines, like it has done, it usually doubles. Not right away, but it doubles. Yeah. And they're very, very, very profitable. And they're boring for most people. They're I know why you like Netflix. But here's an example. GLW is another one where it did the same type of thing. And actually a client Ann, had early recommended this. And she was just spot on. Oops, what am I doing here? It was right down here. We had this kind of whole discussion about how it was starting to break above this trend line. And you can see this thing has been stunning. And again, it's an if-then. If it literally can get and stay above this weekly wedge, very oftentimes they will double in time. So these are the types of plays that even last week, very bullish engulfing. This week follow through. Now it's parabolic. It's going to have some give and take. But from a trend standpoint, 3M and Corning, they look so boring to the outside world. To me, this is what I love. I love finding these oversold plays and then they completely trend reverse. You're talking about a beautiful, FANG 7 all-time high that's making new all-time highs, and it's just unrelenting. This is just gorgeous. And we'll see how far it can actually run. Hot, hot sun. I've got about 1,035 where it should start to digest, and then we'll see what it's made of. But great, both ways work as long as they're moving in a direction. Yeah. All right. So what else are you trading? I know
That's
Oh
a
my God, I
nice old,
love it.
that's a blast from the past, that Corning there, Corningware, right? The Corningware, the fiber optic hold, that, and I like those finance plays. What you can do on those is kind of, you can also, once it starts to get going, what you can do is you can take off a little bit of the risk and buy back that put. So if you sold a put, for example, I'll show you where I did it here. We talked about this play last time where
Which
I did
one?
the financed upside on Nvidia. We sort of had that, everyone recalls this big breakout and then this massive, I don't show any color here, but this was that massive red
Okay.
candle with the reversal on Nvidia. And then that's when everything just kind of started spiraling to the downside. And we came down almost all the way down to this trend line here. And I had this short put, I put on this finance play up here, short put with an upside call spread. And one thing I like about those plays is you always have a little bit of a piece to play with if things kind of go the wrong way. And I always like that because then I can kind of reevaluate. So worst case scenario, I know I'm going to own Netflix under 130. Fine. But we got down to a spot where I thought, it's starting to get fairly cheap. We're getting down to some levels technically that look interesting to me. The market overall was really kind of not pushing too much lower below 5,800. And so we had this opportunity. So I bought the short puts back, which then kind of juices my upside again. So then what happened was we started to rally up towards 140. And I paid 205 for the calls. Did I say puts? I bought back the calls that I sold way up here in my call spread. So you're long a call spread, you're short a put, the market comes down, you buy back the short leg of the call spread, and then all it leaves you is short the put, long the call. Now, what you can do on the bounce back is you can resell that call that you bought back, you can resell. So it turns the whole thing into a much cheaper structure. And before I put it on for nothing. So now I've got the whole structure on for, I don't know, like a $3 credit or something like that. So it really makes it very interesting. One funny thing though is, and this is a lesson in Vega, is I bought the call back down around 131 and the stock rallied about $7 and I went in to look at these calls again to see if I could get some value out of that to resell those. And they were trading at the exact same price. And so I said, well, I said to a few of my students, I said, well, why do you think that happened? And one of them said, the volatility came down. So the stock went up $7 and the calls did not move. And so what was interesting is that we could really see that Nvidia volatility was getting very, very low. So I'm showing you guys here. You can see the blue line here is your implied volatility. This is short term, 30-day. So here it is. It tends to run up into earnings, then get crushed. And this time we saw sort of options really get crushed in Nvidia, and it got down to probably, I don't know, 10th percentile or something like that, or 15th percentile. And that's also when I thought, well, I got to get those calls back. But what happened was it just kept dropping. So I got into them here. The volatility kept dropping, and that's the Vega exposure that you have with options. You don't just have theta and things like that and delta. There's Vega. If you buy a high vol and it can still compress, and you see that play out. And so then it started getting going. And yesterday I said, these options are getting too cheap. And so I went in and I bought some May 160s just because everything just had gotten too cheap. And sure enough, what we saw today was a little bit of a spot up, vol up. We saw a pop in Nvidia as well as an increase in volatility, as well as an increase in option pricing. So really interesting things going on out there and nice opportunities. If you take the time and monitor option pricing, which I suggest you always do when you're an option seller, because believe it or not, when you're trading options, you're trading volatility, you're trading sentiment, you're trading the prevailing market sort of view of where things are going. And that can be very, very exuberant and it can be completely complacent. So, and everywhere in between, there are going to be opportunities. So you want to know, is that volatility high? Is that volatility low? An example of that was the MSTR trade that I did a few weeks ago. We talked about that last time, I think, or 2 weeks ago. And I said, this is an area where I could be long some MSTR options and potentially benefit from an explosion in volatility. And that's exactly what happened in there. Now, I did it again. Oops, I did it again. But this time it wasn't oops. And we had MSTR a few days ago, started to run into the election. And I said, you know what? I'm going to take a shot here. The option pricing was getting a little bit low. again, not as low as it was when I put on that original strangle, but it got down again. And I thought, you know what, for the event risk, I think it's kind of interesting to own this thing here. And I was right for a day. It jumped up. I was up a whole bunch of money on this position. I thought, you know what, should I hold on to it for the election or for the inauguration, or should I just let this thing go? And I said, you know what, I'm going to hold on to it. Let's give it a chance. And if it pops after the inauguration, I can start to neutralize some of that risk either by selling a call, getting rid of the position. There's all kinds of ways to deal with that. And it came down yesterday, bounced all the way back, and then came down today. And I said, you know what, I'm going to get rid of this position. And don't be afraid to get rid of a position when your sort of feel or your thesis changes. So I took a look at this position again today and I said, you know what, at this point, I feel like I don't have a view on volatility. It's probably on the low side. It came off a little bit. I have Vega risk because that the options, if MSTR, especially after that big share approval, maybe it just kind of sits around for a little bit, especially if Bitcoin doesn't get too far away from 100 grand, either one, up or down. It could just sit around a little bit. And so I don't really have a view on it. So the view that I had on those last two trades, one was a really big winner, and this one ended up being a very tiny loser. But I wasn't afraid to say, you know what, I don't have a feel. I don't have any edge on this right now. I don't know if the volatility is low. I don't know if it's high. I look at this chart, maybe it's looking okay, but it's not exhibiting the kind of behavior that I want to see for something that's really about to go. And frankly, the event is over. The inauguration's over. We've had this unbelievable, we had the crypto ball on Sunday, whatever the heck that was. We've had all these amazing things happen, and it hasn't been acting well the last couple of days. I don't mind sitting this out until I see the next opportunity, that next sign on the chart, that next event, whatever it is that gets me compelled. But I don't want to just sit here as this vol drops and this thing costs me a few $1,000s for no reason when I don't have any edge anymore, in my view. So for anybody watching, don't be afraid. Just go, you know what, I just don't, I'm not feeling it anymore. And I can take a little bit of a loss just to get out of a position that I don't have a view on anymore.
Georgia is asking a question. Does Nvidia IV act like GLD typically, where the skew is to the call side?
No, it doesn't. Now, on occasion, there were a few earnings reports ago where it was absolutely like that. I mean, it was FOMO, panic side to the upside, like I haven't seen in a very long time in a stock, and especially unusual for a company of that size. So it can happen. You can go, there's some nice tools like Market Chameleon. You can go in and take a look, see where that skew is sitting. But that is a little bit unusual. You'll see that definitely in stocks where there's sort of parabola type moves happening. But yeah, most of the time that's relegated to like a gold, to like a Bitcoin, MSTR, for example. Not unusual to see that upside call skew quite steep.
And speaking of GLD, can I show my chart?
Yes.
All right. So since she's asking, I really liked this setup a few weeks ago, where first and foremost, into the election on the 29th, I warned, yeah, be careful the gold and silver, because if Trump wins, which was my baseline bet, yours too, then Bitcoin's going to get the flow. Just talk about money flow. And sure enough, this did dump. We had some war vibes, but basically it's not out of play on a trend basis. I'm very, very bullish gold and silver on a trend basis. And I'll show you that chart just for comparison purposes. This is a gold silver ratio. Very, very gorgeous chart on a monthly. And this ratio is beating the 2011 August high. It's stunning. It's stunning. I love this. And in fact, I posted this even on Twitter, not just for clients, so I show this every single day. But it is one of those deals where March right here, this is April 1st. This is February, March right there, that green candle. I said this is the most bullish chart I have, because this was just a gorgeous pattern for continuation. Now we had a few months of digestion. It had already gotten too extended and it came back in. Here's your 10. I like the 10 week. This is a 10 EMA on a monthly. Long story short, I'm very bullish on a trend basis. But that doesn't mean people are patient enough to want to just hold. And there's a lot of gyration. So gold got back in play. And 3 weeks ago, I said, I really like this. I really like this bullish engulfing. All we need to do is follow through, keep that 10 and 21 moving average higher, make sure we stay above the kind of 245, 247, and here we are. So GLD to me is doing fine. And that is not just because the dollar and yields are coming down a little bit. There's a lot of macro, uncertainty around Trump's whole tariff and what percent's going to do in the Treasury, et cetera, et cetera. Long story short, silver is very different as it follows like a month later. So I know it's frustrating, but there is no trend. There is trend in GLD again. There is definitely a trend big picture on a monthly, but silver's just a hot, sloppy mess. Jeffrey was really the one who in April said this thing was going to break out 10%, and it did. So he has his certain methodology of trading SLV, and it's very, very tied to inflationary proxies. And one thing, Georgia, if you're interested, or Hans, pop up a chart of DBA. DBA is actually an agricultural ETF. This gap down does not mean it did anything wrong except issue dividends. So don't get scared away just because of that gap. Anyway, the point is, this is kind of your inflationary proxy on soft commodities, and gold is precious metals. And then you've got your hard commodities, which XME is still trying to come up off the bottom. So silver's still suffering, but big picture, from a trend standpoint, they got it going on. They've done nothing wrong from a trend standpoint, but the patience of holding for months on end while you're watching all the crypto bros invest 1 million in the new Trump coin, and the next day, literally 24 hours later, not even, they're up 300 million. So it feels a lot, but that's the insider scoop of being, in the fold with Trump. That's definitely, his team or the insiders on his team being rewarded. The point is, we know that we can't play that game. So I like gold and silver, long story short.
Right.
But silver,
very nice.
Silver takes some time before it gets going. Okay, so what else are you kind of looking at into this? We're at all-time highs. We're in blue skies. However you want.
I know. Well, I've got a couple of hood positions, a finance play on hood, which is one of my favorites, Robinhood. We've been talking about it for a long time. And just to come full circle on your Corning and a couple of ideas, you're mentioning your finance plays. What I did today is, I sold I'm going to throw this back on here. So I sold the June hood was around $39. I sold the June 31 for 286, and I bought the 42.55 call spread. So, kind of playing for that upside. Little bit of a debit to put this on. I felt very strongly about it, and we've had this run up to $50. And so what I did today is I said, I mean, it's had a great run, but I want to maintain a little bit of that upside. And so when you have a play like this, whether it's a financed one or not, whether it's it might be just a call spread, and the call spread's priced very well on something like this. So to the question earlier, sometimes plays like this, because it's slightly crypto related and it's a bit sort of memey, sometimes you get that.
That's, by the way, the platform for the Trump coin, who put in 1 million and came out with 300 million in profits a New York minute later. It was on hood. They're making transaction fees off this. So you got the tiger by the tail. You got the tiger by the tail
with this. I know they've got a lot of good things going here. That's a good point. So again, what I did today is I took off the put. So again, remember we talked about Nvidia having that little piece that you can play with. Well, if the stock comes down, you've got the call to buy back, the short call to buy back, as we did on Nvidia. Now, if the stock goes up, you've got the short put to buy back. So I bought that back at a buck, and I take the risk off the books that I could end up owning this thing at $31. So I take that off. Of course, it cost me $1. It cost me $1.11 or something like that. But what I also did is I monetized some of this call spread. So I had the 42 call, and what I did was I said, I could just take the whole call spread off and call it a day. But what I did was I said, I want to maintain a little bit. There's still a little bit of value left in this because the stock's at $50. I'm short the 55. There's still, if we were sitting at 60, I might be tempted to just say, I'm just going to get rid of this whole thing. It's a high long delta at this point, so to speak. Let's just get rid of it. But I think there's still a little meat left on the bone, perhaps. So I rolled the 42 call up to the 48. And so I put about 350 in my pocket. So now I've got this 48.55 call spread that I still have on the line. I've covered the put as well. So I have I've put the whole thing, can't lose money. I've put some money in my pocket, but now I can really, really make an extra $5 or $6 fairly easily if this thing continues to go. So that's to your plays earlier for your clients. What you can do is you can kind of roll up that long call in order to lock in some of that benefit. Or what your clients could also do is if it's getting close to expiry, they could just roll that whole call structure up. So if they're long, say a 50-55 and Corning goes for a nice little run, they could roll it up to the 55.60 or the 58.63, something like that, just to kind of take some of that long delta off the book and then, but still maintain some of that upside, which I kind of like to do because I hate it when I have a really, strong idea about something. I sell it out and then it goes for another 10 or 15 bucks. And I feel stupid because I had this great idea. So I always don't be afraid to keep a little skin in the game just to kind of stay involved. It doesn't have to be as big as the first sort of tranche that you put in, but a little bit of that upside and still keep on.
Are you, okay, this is your hood. I just want to update kind of a TLT trade, which is still working, and it's actually very much tied to equities moving higher. So let's just kind of show that one real quick before we close, or any other questions, hit us up.
Do you still like it, Samantha? You still like TLT? You think it's still got
I cover this one constantly. So hold on one second. Let me just show this chart because I think it demonstrates why I recommended, why I was excited about it, because it was like really oversold and it was due a pop, and that's why the bull risk reversal worked so dang well. Okay, so long story short, you've got back on the 14th. This is going to surprise people, but I'm going to show how I got into this because this matters from a macro standpoint of why I suggested this. So this happens to be the 10 and 2-year yield curve. Not usually discussed in option webinars, but I have a means to my madness, so stick with me. When I was recommending that we were going to have a yield spike, which was September, the morning of the September 18th, before the Fed did their 50 basis point rate cut. All right, so that basically set in precedence this kind of cheap and steep formation where the 10 was going to fall faster than the 2. And long story short, we were going to get this kind of bear steepening effect. And this was in large part helping my thesis that yields would move higher with dollar. That all happened. And then we get the inauguration. But before the inauguration came in, I could see that this was starting to flatten. I could see that Trump was going to really try and goose the markets. So it made sense if the dollar would soften with the yields. And this is basically kind of showing you this flattener. We didn't quite make it up to my 45, but why I'm showing this side by side, the day versus the week, is that this was exactly when I said, okay, on the 14th, the morning of the 14th, I said, it's time for a yen and bond bounce. He's going to come in, he's going to push peace, Bank of Japan might hike, you've got CPI that might be hot. There's so many reasons why bonds could bounce here. Long story short, that was exactly the timing. On the 14th, bonds were extremely oversold, and I'm talking about the 10 and 2-year side by side, but I'm also talking about, this was right here. It was right down here. And here's the 14th when I recommended that TLT bull risk reversal, sell the 85 put, buy the 85 call for a nickel, and it's up 6,800%. Now, the point is, this was really well timed because of that oversold nature. But just the other day, and just yesterday, in fact, right, I'm like, okay, it's time to take at least 50% of that off because I expect this is where we're going to do some digestion for a little bit. I'm still bullish. I still think that this actually is a good play to hold on to in case the Bank of Japan does hike. If they do hike on Friday, yen gets a little bounce, bonds get a little bounce, yields soften a little bit more with dollar. I don't think it's going to go above this kind of 89.5, lots of ways to play a bond bounce, or like I just showed you with the yield curve, or like I just showed the T-note futures. But the point is, I liked this, and I like it still.
What's the magenta line? Is that the 9 EMA, Samantha?
Where? What? This is the week. This is the day. This is the
hour. On the daily.
8.
Oh, the 8. Okay.
Yeah. So right now it's pushing into the 21 day. So it gapped above the 3, the 8, and it pushed into the 21 day. This was my first price target in a nutshell. This is where I just showed you the flattening. So this flattening in the yield curve is what I expected. And so we made it up to this first price target. I think we go sideways a little bit and make it up to the next one and then go back over. So I'm still big picture, very bearish bonds, but this is a gorgeous bullish engulfing. Typically, probabilities are you're going to have a little follow through, and then you're going to have a little follow through into the 10 week. Anyway, that's a mean reversion. See how this pops up into a mean reversion trade, and then it continues lower. this is just a mean reversion. It's just a mean reversion trade for me. It doesn't mean I'm expecting anything different than what I just showed in that yield curve, which is, I think, when this equity bounce is done, this is on a daily and it looks like it's broken. But on the weekly, this is just reversion to the mean. I think it's going to come right back down here and steepen again. So I think we only have Q1. I think Q2 is going to be very, very different animal. And I can see this steepening some more. So anyway, that's how I came about the bond bounce. And I still, believe it or not, am bullish.
All right, next time we're going to talk about some hedging, okay? Because
okay.
It sounds like the timing is right for that.
All right, so that's it. I think if we get a hike, long story short, it does mean some interruption to this bullish flow in equities. Folks are not expecting or caring about it. So that could be very short-term bearish for equities. But we have earnings season. A lot doesn't really a direction of the market. Right now, we've just had this massive bounce off of the election low. I'm not really seeing the melt up yet. Unless BOJ does nothing, then we actually have a chance of further melt up. If they
then
hike,
more melt up.
And then I think we can absolutely soften and roll over. But all eyes on literally yields and dollars softening, then they're going to get supported and move higher again. Baseline is the risk for this equity advance. And if they don't, we get a melt up.
If we don't,
we get a melt up.
We melt up. We keep melting up. And the upside is, it's inexpensive again. It's looking kind of interesting, which is what we often talk about when everyone's focusing on that left tail. The right tail looks interesting. So we just had a quick question about this volatility graph. What is it? Well, this basically just shows you pricing. This here is 90-day option pricing. So this, you can see that options fluctuate over time. And so this was part of my Netflix ideas that somebody would ask, well, why did you sell options today after they got crushed? Well, sometimes that's the best time to sell because the event is done. We still have a little meat on the bone. So I sold it up around in here. And I think there's still a little bit of room for what I talked about earlier, which was that Vega exposure. So you're short Vega when you're short options. And the further out you go, the more Vega exposure you have. So versus a Feb, I've got 2 months now. I'm looking at a March. And so I have just a little bit of extra potential for volatility to drop. Unless Netflix starts to kind of push lower towards 900, then this may not fall as quickly as I'm thinking. But if it stabilizes here, I think that goes down. We grab a little bit of Vega exposure, then theta starts to take over for the trade. So always understanding where's your torque coming from? I always like to say, where's your torque coming from? What Greek is it coming from? Well, in this case, I think there's a little bit of torque left on the Vega, which is volatility dropping in those options. Those are quick wins. And then the theta takes over, and then it's just a matter of time passing by as the theta decay comes in day after day towards expiry. But I do like to close these things well before expiry. So a couple different ways to make money on that.
I wonder if that red line is going to represent my 1,035 price target on Netflix.
But good, you're right. That's the spot.
And Georgia has a question about your reasoning for using a June expiry rather than, say, a March on your hood.
Oh, on the hood, yeah. Well, I wanted to give myself some time just for it to play out. So when I'm not quite sure when it's going to happen, I want to give myself just a little bit of extra time. It allows me for a more distant strike as well. So the closer in you come to a month, 2 months, it's difficult to create that structure without being, without selling a put that's a little bit close for comfort for me. So this gives me a little bit more room in terms of breathing room on the structure. Get a little bit more generous in terms of how far that put can be. And then it just gives me a little bit of ability to, a little bit of patience. One thing I like is option trades that give me a little bit of patience. I never like to feel like I'm under the gun. I told you guys about that MSTR trade that I did not long ago, and I kind of cut it loose today. Part of the reason is it's a trade that's going to be prone to some, to time passing by and could hurt me in that way. So when I have sort of a longer term idea, I like to give myself a little bit of extra time. But if you feel very confident about something happening sooner rather than later, then you're going to get more gamma out of those shorter term options, right? You're going to get that bang for your buck that you get with short term options.
And last question, Rish is actually asking about an IPO window. See Meta investment into Databricks pre-IPO news. Databricks is also also a Pelosi pick. So for those who follow along Nancy Pelosi as a sentiment tell, she recently VST and TEM and more Google and Amazon, a little bit more Nvidia, but she had a really big position, like $12 strike. So she exercised a lot of that Nvidia. Anyway, long story short, she's still insider trading and still very bullish the market. And she's an investor in Databricks. So it's still a sentiment tell within the tech ecosystem, and some of the SaaS reacceleration plays are also still doing well in the mid-tech arena, but this is still a big party on, Garth, for the Mag 7. And with that, my cat just showed up to say, feed me. You're gonna get a cameo in 2 seconds. So I'm gonna wish everyone a great evening and say thanks, Hans. We'll do this again next Wednesday at 4. See what we have got for potential earnings drama from the next round, which will be very eventful now that we got Netflix out of the way. We get to see some other big hitters come in. So we'll probably be live during like Microsoft. So
Awesome. Thanks, Samantha.
all right.
Thanks everyone
Cheers,
for coming.
everyone. Bye.
Subscribe to LaDuc Trading YouTube channel for more macro to micro options power hour and other content.